Welcome to a deep dive. Today, we're cracking open a resource that gives you a real behind the scenes look at the world of securities research analysis.
That's right. We're using this workbook. It was actually designed for the NEISM Research Analyst Certification exam,
Yeah.
but honestly, it's just a treasure trove of fundamental knowledge.
Yeah,
Yeah, if you want to understand how the pros analyze companies,
yeah.
markets, investments, this is kind of your shortcut.
Absolutely. Think of this deep dive as getting, inside the analyst's head. What tools do they use? What signals are they looking for? How do they try to make sense of these really complex financial landscapes?
hmm
We're going to pull out the most important nuggets from this detailed material, really focusing on the insights that matter for you.
We'll journey from the big picture, markets and economies, then dive deep into understanding specific industries, individual companies,
Hmm.
looking at everything from their business model, management, financials. Then we'll touch on things like corporate actions, valuation, risk and return, and the crucial rules that govern this whole thing.
It's a lot, definitely. But our mission is to make it clear and relevant.
Okay, let's unpack this. Who is a research analyst, fundamentally? And maybe what makes a good one?
Well, at its core, a research analyst is a professional. Their job is to study companies, industries, sometimes entire sectors, really comprehensively.
And the goal.
The goal is basically to help others, their clients, make more informed decisions about investments.
And they don't all work in the same place, right? They have different roles.
Exactly. You typically find them on what's called the sell side.
Sell side.
Yeah, working for firms that provide services like investment banking, broking, advisory stuff. These are the analysts generating reports, price targets, the kind of thing you might see quoted publicly. They're essentially selling their research to clients.
Got it. Selling research.
Yeah.
And the buy side.
So the buy side is where analysts work for asset managers. Think
Hmm.
mutual funds, hedge funds, pension funds, that sort of thing.
They generate research mostly for internal use to help their own fund managers decide what to buy or sell for the fund's portfolio. They're buying assets based on their research.
So, same fundamental task analysis, but different audiences, different end goals. What kind of skills, what mindset do you need for this? It sounds demanding.
Oh, it is.
Yeah.
It's definitely more than just being good with calculators, though that helps.
Ah, I bet.
You need a really strong grasp of financial concepts, obviously. The ability to read and understand financial statements is non-negotiable.
Right.
But beyond that, you need sharp analytical ability, a really inquiring mind, always asking why,
Yeah.
and discernment. You've got to sift through mountains of information, figure out what's truly relevant.
And independence, I imagine that's crucial.
Absolutely critical. Your analysis has to be based purely on factual information, not personal opinions, not biases, and crucially, never on any non-public, insider information.
That makes sense.
You need to be independent in your thinking and your process. Trust is built on that objectivity.
Okay, total sense. You're building trust. Let's shift gears slightly. Talk about the foundations, the securities markets themselves. What are we actually talking about when we say securities?
Right. So securities are essentially transferable financial instruments. Think of them as representing either a debt someone owes you money or ownership you own a piece of something.
Okay, so equity shares, like common stock, that's ownership.
Yes, exactly. Common or ordinary shares give you a piece of ownership in a company. Usually means a claim on its profits and assets, but after everyone else gets paid. And typically, voting rights.
And preference shares.
Slightly different. They usually get priority for dividends and capital repayment if things go south, but often have different rights, otherwise maybe limited voting.
Okay. And debt instruments.
That's where companies or governments raise money by borrowing. You have longer-term debt like bonds and debentures, and shorter-term stuff like treasury bills or commercial papers.
Right.
Debentures can be straightforward debt, or sometimes they can be convertible into shares later on, which makes them sort of a hybrid.
Ah, so you've got pure ownership equity, pure debt, and things that blur the lines.
Exactly. Hybrid instruments blend features of both, like those convertible debentures we mentioned, or certain types of preference shares.
The source also mentions some interesting ways to invest overseas without actually going overseas.
Ah, yes. Depository receipts. Things like IDRs in India or GDRs and ADRs internationally. They let you buy shares of a foreign company through your local stock exchange.
How does that work?
Well, they represent underlying shares held somewhere else, usually in the company's home market. You generally get the dividend and capital rights, though voting can sometimes be a bit more complicated.
Interesting.
And then there are other structures like REITs and invites. These let you pool money to invest in big real estate or infrastructure projects that generate income.
Okay.
Oh, and the source also mentions precious metals, like gold and silver, mainly as tools for preserving value rather than generating income typically.
So where does all this buying and selling actually happen? What are the markets?
Markets basically have two main stages. First, you've got the primary market.
Primary.
That's where securities are issued for the very first time. This is how companies raise fresh capital. Think initial public offerings, IPOs, follow-on public offers, FPOs, or maybe rights issues, where they offer shares to existing shareholders.
Okay, so that's the first sale. What happens after that?
Then they trade in the secondary market. This is what most people think of as the stock market.
Right, the exchanges.
Exactly. Exchanges like the NSE, BSE in India, or others globally. Here, existing securities just change hands between investors. It's typically done electronically now through systems that match buyers and sellers anonymously based on price.
It sounds like it takes a whole ecosystem of players to make this work.
It really does. You've got the investors, obviously everyone from individual retail investors like you or me perhaps to huge institutions like mutual funds, pension funds, insurance companies. But then you have a whole host of intermediaries. The stock exchanges provide the platform. Depositories like NSDL and CDSL in India hold the securities electronically in dematerialized form.
Okay.
Brokers execute the trades for investors. Custodians hold assets safely for big institutions. Clearing corporations make sure the trades actually settle money, changes hands. Securities change hands correctly. Clearing banks facilitate the money movement.
And advisors?
Yes, investment advisors help people decide where to invest. And underwriters help companies when they're first issuing securities in that primary market. It's a complex, interconnected system for sure.
Okay, so we understand the kind of building blocks and the trading venues. Now, how do analysts actually approach figuring out what these securities are worth? The source outlines a few different ways.
Right. The main one, and really the focus of this material, is fundamental analysis.
Fundamental analysis. What's the core idea there?
It's all about getting to the fundamental or intrinsic value of a security.
Sync value.
Yeah, what it's really worth, based on its underlying reality and future potential. This means doing a deep dive. You look at the company itself, its business, its management, its financials. You look at the industry it operates in, the overall economy, even the regulatory environment.
So you're trying to understand the true worth, not just the current stock price.
Exactly. It involves digging through publicly available information, annual reports, news, industry data. Sometimes analysts do primary research too, like visiting company facilities or talking to suppliers or customers. But, again, crucially, never using material non-public information. That's insider trading.
Okay, so it's about the substance, the underlying reality. How does that contrast with, say, technical analysis?
Technical analysis is quite different. It's less about the substance and more about the pattern.
Pattern.
Yeah, technical analysts study historical price movements and trading volumes. They look for trends upwards, downwards, sideways on charts. They use tools like support and resistance levels, moving averages, volume analysis, trying to predict future price action, and gauge market sentiment or psychology.
So timing and momentum rather than intrinsic value.
Generally, yes. It's a specialized skill set, focused more on market dynamics than the company's fundamentals.
Got it. Patterns versus underlying value. What's the third approach mentioned?
Quantitative analysis, or quant analysis. This uses mathematical and statistical models to try and forecast financial variables, things like sales, earnings, maybe even stock prices.
Is that a big part of the fundamental analysis process we're focusing on?
Well, the source points out some limitations for its use in pure fundamental analysis. Things like changing accounting standards or shifts in a company's business model can make historical data less comparable, less reliable for purely quantitative forecasting.
So useful tools, but maybe not the whole story for a fundamental analyst.
Right. While quantitative techniques are obviously hugely important in finance overall, a purely quantitative approach isn't typically the sole method in the kind of fundamental analysis described here.
And finally, there's the behavioral side. This sounds interesting.
It is fascinating. The behavioral approach looks at how human psychology, our biases, affects investment decisions.
Biases like...
Oh, things like fear and greed, obviously, but also overconfidence, Anchoring bias, where you get stuck on an initial piece of information, confirmation bias, seeking out info that confirms what you already believe, herd mentality, just following the crowd.
Right.
Understanding these biases helps analysts understand why market prices can sometimes deviate, sometimes significantly, from what fundamental analysis might suggest is fair value. It acknowledges that investors aren't always perfectly rational robots. Our decisions are often influenced by these psychological factors, leading to suboptimal choices.
That adds a whole other layer, doesn't it? It's not just about the numbers and models, it's also about people. Okay, so to really do that deep dive, that fundamental analysis, you have to start big picture, the economy.
Absolutely. Economic analysis is crucial. The broader economic environment impacts pretty much everything. Industries, companies, consumer spending, borrowing costs. You need to understand the context.
And that involves both micro and macro.
Yes. Microeconomics looks at individual firms, consumer behavior, how prices are set for specific goods. Macroeconomics looks at the big picture, the aggregate economy. What drives national income, savings, investment, employment levels?
What are the absolute key macro variables an analyst keeps an eye on?
Well, national income figures are foundational. GDP, gross domestic product, tells you the overall size and growth of the economy. Per capita income gives a better sense of average living standards.
Okay.
Savings and investment rates are vital. For an economy to grow, savings need to be channeled effectively into productive investments. Inflation is another big one.
Measured by?
Things like the Wholesale Price Index, WPI, or the Consumer Price Index, CPI. High inflation erodes purchasing power, impacts business costs, and influences central bank policy.
And government actions play a big role.
Definitely. Two main levers. First, fiscal policy. That's about government spending on infrastructure, healthcare, defense, etc., and taxation. Is the government spending more than it earns to stimulate the economy? Maybe during a recession, that's expansionary. Or is it spending less to cool things down, perhaps during an overheat? That's contractionary.
And then the second lever.
Monetary policy. This is managed by the central bank, the Reserve Bank of India, RBI. In India, they control the money supply and interest rates. Using tools like the repo rate, the rate at which banks borrow from the RBI, the reverse repo rate, cash reserve ratio, CRR, statutory liquidity ratio, SLR. By adjusting these, they influence the cost of borrowing throughout the economy. Lower rates tend to stimulate, higher rates tend to restrain.
And we can't ignore the global picture, I guess.
No way. Especially today. International trade exports, imports, the balance of payments, exchange rates, they all matter hugely. Economies are incredibly interlinked now.
Globalization.
Right. Globalization means companies can produce and sell almost anywhere. Resources, capital, sometimes even jobs, flow across borders. This brings positives, more choice, competition, efficiency, but also negatives, potentially widening inequality, job migration, and integrated risks. A crisis in one part of the world can spread very quickly, like we saw in 2008.
And the economy isn't always smooth sailing. It moves in cycles.
Correct. Understanding the economic cycle is key for forecasting. You typically see phases like boom or expansion, then a slowdown, possibly a recession, followed by recovery. Different industries perform very differently depending on which phase of the cycle we're in.
Are there other cycles analysts watch?
Yes, the source mentions commodity cycles driven by supply and demand for raw materials, often linked to the broader economic cycle, and inventory cycles, which tend to be shorter-term fluctuations within those broader trends.
Okay, so economy first. Then analysts need to zoom in on the specific industry a company operates in. Why is that level important?
Because companies don't exist in a vacuum. You need to understand the competitive dynamics, the structure, and the future prospects of the industry itself. Is it a growing industry? Is it mature? Is it facing disruption? That context is vital for assessing an individual company within it.
What are some of the challenges in analyzing an industry today? Just defining it sounds tricky sometimes.
It really is getting harder. The source gives a great example. Think about PVR cinemas. Are they just competing with other movie theater chains?
Probably not anymore.
Right. They're competing with Netflix, Amazon Prime, Disney Plus.
Yeah.
The OTT streaming giants. They're competing with live events, concerts, maybe even video games for people's leisure time and money. Companies often operate across multiple competitive spheres now.
And different industries react differently to those economic cycles we just talked about.
Definitely. This is the concept of industry cyclicality. Some industries, like consumer staples food, basic household goods, or pharmaceuticals, are often called defensive. Demand for their products is relatively stable, regardless of whether the economy is booming or busting. Others, like capital goods, heavy machinery, or automobiles or construction, are highly cyclical. They do really well when the economy is strong, but demand can fall off a cliff during recessions. Understanding where an industry sits on that spectrum is important.
How do analysts try to gauge an industry's future prospects?
They look at market sizing. How big is the potential market? And what's the growth trend? An industry serving an underpenetrated market might have huge growth potential ahead. They might do this using a top-down approach, starting with the overall economy and working down, or bottom-up, looking at individual companies and aggregating up.
Beyond cyclical growth, what about longer-term shifts?
These are secular trends, big long-term shifts that are often independent of the short-term economic cycle.
Examples.
Think about major technology changes, like shale gas exploration changing the energy landscape, or digital cameras wiping out film, or the current shift towards electric vehicles, EVs, or changes in income levels leading to demand for more premium goods, or demographic shifts, like an aging population impacting healthcare or leisure industries.
And these trends can really shake things up.
Massively. They can cause what's called value migration, where the profit pool shifts from one part of an industry's value chain to another, or even from one industry to a substitute. Think about the price wars in the Indian telecom sector, how that shifted value. You can also trace these trends through a typical business life cycle model: startup, growth, maturity, decline, maybe reinvention.
Are there standard frameworks analysts use to analyze the structure of an industry?
Yes, a very famous one is Porter's Five Forces. It's a classic framework for analyzing industry structure and attractiveness.
Five forces. What are they?
Okay, they are: 1, the threat of new entrants. How easy is it for new competitors to come in? 2, the threat of substitute products or services. Can customers easily switch to something else? 3, the bargaining power of suppliers. Can they dictate prices to the industry? 4, the bargaining power of customers or buyers. Can they dictate prices? And 5, the intensity of rivalry among existing competitors. How fiercely do the current players compete?
And analyzing these helps you understand.
It helps you assess the overall attractiveness of the industry and the likely pricing power of companies within it. An industry with high barriers to entry, few substitutes, weak suppliers and buyers, and maybe not so intense rivalry. Well, that tends to be a more profitable place to be.
Makes sense.
The source actually includes that famous Warren Buffett quote here, something like, "When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact."
Ouch. So, even great management struggles in a fundamentally unattractive industry.
That's the idea. It really hammers home the importance of the industry structure itself.
Are there other frameworks?
Yes, pestle analysis is another common one. It looks at the broader external factors influencing an industry: political, economic, social, technological, legal, and environmental. It helps understand the macro forces at play.
Beyond the structure, what else is critical in industry analysis?
Understanding the specific key industry drivers and key performance indicators, KPIs. What are the unique metrics that really tell you how this particular industry is performing and what drives success?
Like what?
It varies hugely. For airlines, it might be things like passenger kilometers flown, revenue per available seat kilometer, or ASK, load factors. For banks, it's loan growth, net interest margins, deposit growth, capital adequacy ratios, non-performing asset NPA levels. For retailers, maybe same-store sales growth, inventory turnover. For IT services, maybe utilization rates, billing rates per employee. Identifying these key drivers is essential for forecasting performance.
And we can't forget regulation.
Absolutely not. The regulatory environment and specific taxation policies can make or break an industry or significantly alter its economics. Think about changes in environmental policies impacting manufacturing or telecom license conditions or the introduction of GST. Analysts have to pay very close attention to the legal and regulatory landscape.
Okay, so economy, then industry analysis. Now we finally drill down to the specific company. Where does an analyst start there? The business itself.
Yes, fundamentally, you have to understand the business model. How does this company actually create, deliver, and capture value? How does it make money?
Why is that so central?
Because, as the source quotes Dr. Gary Hamel, competition in the marketplace is not between products and services, but between the business models of the competing companies. It's about the underlying logic, the engine of the business, not just the surface-level product. Understanding that is imperative.
And what gives a company resilience, staying power in that competitive landscape?
A key factor is pricing power and its sustainability. Can this company maintain or even increase its prices over time without losing significant business?
What drives that?
It often comes from having a really strong brand loyalty, maybe being the lowest cost producer through operational efficiency, or having truly unique products or services that customers value highly and can't easily get elsewhere. It's a critical differentiator and a sign of a strong competitive position.
Which naturally leads to thinking about competitive advantages.
Right. Why does this company outperform its peers? Or why should it outperform? Where does its advantage lie? Is it superior product features? Is it offering competitive pricing because it's incredibly efficient? Is it just better at execution, getting things done? Identifying sustainable competitive advantages is really central to fundamental research.
Analysts often use frameworks like SWOT for companies too, right? Strengths, weaknesses.
Yes, SWOT analysis, strengths, weaknesses, opportunities, threats is a common tool.
Eh,
It helps structure your thinking about a company's internal capabilities, strengths, weaknesses, and its external environment, opportunities, threats.
But it has limitations.
The source offers a good caution here. As an outsider looking in, it can be really hard to know the true internal weaknesses or hidden financial woes or maybe unseen political clout that acts as a strength. SWOT is a useful starting point for organizing thoughts, but you have to be careful not to take it as the absolute gospel truth, especially the internal parts. Focus should be on factors critical to future performance.
Assessing the quality of management seems incredibly important, but also really difficult. How do analysts approach that?
It is subjective, no doubt about it. But analysts try to form a judgment by looking at various factors. What's the management team's educational background and relevant experience? What's their track record? Have they successfully navigated challenges before? How long have they been with the company?
Okay.
Also, their communication skills. How clearly do they articulate strategy? Their strategic vision itself, does it seem sound? And crucially, their execution capability, do they deliver on their promises? Integrity is huge too, and things like succession planning, what happens when key people leave. It's about assessing both competence and character as much as possible from the outside.
That makes sense. And closely related to management quality is corporate governance.
Absolutely. This is a huge focus, especially from an investor protection standpoint. Corporate governance is the whole framework of rules, practices, and processes that ensures accountability, transparency, and fairness in how a company is run, particularly focusing on protecting the interests of minority shareholders.
What specific things do analysts look at?
Key aspects include the composition of the board of directors. Are there enough truly independent directors who can challenge management? The effectiveness of key committees, like the Audit Committee, overseeing financial reporting, the Nomination and Remuneration Committee, handling appointments and pay, and the Stakeholders Relationship Committee.
And disclosures.
Yes, the quality and transparency of disclosures are vital. Another critical area is related party transactions deals between the company and entities connected to its promoters or management. SEBI regulations in India require strict reporting and ideally pre-approval by independent directors to ensure these deals are done at arm's length and are fair to all shareholders. Poor corporate governance is a massive red flag and a significant investment risk.
Okay, so understanding the business, who runs it, how it's governed, what about the risks specific to that company's operations?
Every business faces risks. There are business risks like changes in raw material costs, competition, technology shifts, operational risks, things going wrong internally, execution risks, failing to implement plans effectively. Some risks are known, some are unknown. Analysts need to identify the key risks facing this specific company and try to understand their potential impact.
Where do they find information on risks?
Management commentary in annual reports or earnings calls is a starting point. Analyst conference calls often involve questions about risks. Credit rating reports from agencies also focus heavily on risk assessment. It's about piecing together the picture of what could go wrong.
And finally, on the qualitative side, the source mentions the ESG framework.
Yes, environmental, social, and governance factors. These are increasingly being considered by analysts and investors, reflecting a growing focus on sustainable development and corporate social responsibility.
How does ESG fit into analysis?
The idea is that strong performance on ESG factors, like managing environmental impact well, treating employees fairly, having robust governance, can actually reduce a company's risk profile. It might also lower its cost of capital by attracting investors who prioritize sustainability. Regulators are pushing this too. SEBI now mandates specific ESG disclosures for top-listed companies in India through the Business Responsibility and Sustainability Reporting (BRSR) framework.
Okay, so that covers the business, management, governance, risks, the more qualitative side. Now we move to the quantitative. Company financial analysis. This is where the numbers really come into play.
Exactly. The financial statements are the bedrock here. You've got the balance sheet.
Which
A
is,
snapshot in time. It shows what the company owns, assets, what it owes, liabilities, and the owner's stake, equity, on a specific date. Then the profit and loss statement or income statement.
and that shows.
Performance over a period, usually a quarter or a year. It details revenues, expenses, and ultimately the profit or loss generated during that period. And third, the cash flow statement.
Why is that separate? Doesn't profit equal cash?
Not necessarily, due to accounting rules like accruals and non-cash charges like depreciation. The cash flow statement tracks the actual cash moving in and out of the company from its operations, its investing activities, like buying assets, and its financing activities, like raising debt or equity, paying dividends.
Okay, three main statements.
Right. And crucially, the notes to accounts provide vital details and explanations for the numbers in the main statements. And the auditor's report gives an independent opinion on whether the financial statements present a true and fair view. You look for a clean opinion versus a qualified one or a disclaimer.
There's also a distinction analysts need to make between standalone and consolidated financials.
Yes, very important. Standalone financials are just for the parent or individual company. Consolidated financials combine the parent company with all its subsidiaries, treating the whole group as a single economic entity.
Which one is more relevant?
For understanding the true performance and financial health of a large, complex group, the consolidated statements are generally much more relevant. They show the picture for the entire group that shareholders actually own. Analysts typically focus on consolidated numbers, although getting quarterly consolidated data can sometimes be a bit harder for some companies compared to standalone.
Drilling into the balance sheet, what are a couple of key metrics analysts pull out?
Working capital is a big one, usually defined as current assets minus current liabilities. It essentially represents the money locked up in the day-to-day operations, funding inventory and receivables, offset by payables. Analysts might look at core working capital, excluding short-term cash or investments, often calculated as inventory plus trade receivables minus trade payables. Managing this efficiently is key.
And debt.
Absolutely critical. Looking at total debt is essential. A key ratio here is the debt-to-equity DE ratio. It measures how much debt the company uses relative to its own equity capital. Too much debt significantly increases financial risk, the risk of not being able to meet interest or principal payments. A DE ratio below 1 is often considered a conservative benchmark, though acceptable levels vary by industry.
Okay, moving to the profit and loss statement. What are the key profitability numbers analysts focus on?
You start at the top with revenue or sales. Then you subtract the cost of goods sold, COGS, for manufacturing firms to get gross profit. Though the source notes this can be hard to calculate consistently for Indian companies due to reporting variations.
Then what?
A very widely watched figure is EBITDA earnings, before interest, taxes, depreciation, and amortization. It's often used as a proxy for the cash profit generated from the company's core operations before considering financing costs, interest, taxes, and non-cash expenses like depreciation and amortization.
Why is it so popular?
It allows for better comparison between companies with different capital structures or depreciation policies. Analysts often use an adjusted EBITDA, stripping out any one-off or exceptional items to get a clearer view of underlying operational performance.
And below EBITDA?
You have EBIT earnings before interest and taxes, which does account for depreciation and amortization. And then, after subtracting interest and taxes, you arrive at the bottom line. Profit after tax, PANIER, or net income. This is the profit available to the company's equity owners. Analysts also look at the effective tax rate the company pays.
And analysts don't just look at these absolute numbers, they use ratios extensively.
Yes, ratio analysis is incredibly powerful. Ratios put the absolute numbers into context. They allow you to compare a company's performance at financial health against its own history, against its competitors, peer analysis, or against industry averages.
Why is comparison so important?
Because a number in isolation doesn't tell you much. Is it a profit margin of 10% good or bad? Depends on the industry and whether it's improving or deteriorating over time. Looking at ratios over multiple years, say 3 to 5 years, gives you much better insights into trends than just looking at 2 years.
Can you give an example of a ratio that's particularly significant for investors?
The source highlights return on equity, ROE, as arguably the single most important parameter for equity investors.
How is it calculated?
It's net profit, PIT, divided by shareholders' equity or net worth. Essentially, it tells you how effectively the company is using the money that shareholders have invested in the business to generate profits. A consistently high ROE is often a sign of a high-quality business that allocates capital well. There's even a way to break ROE down into its components called DuPont analysis to see what's driving it.
What about return on all the capital, including debt?
That's where return on capital employed, ROCE, comes in. It's usually calculated as EBIT divided by total capital employed, which is typically debt plus net worth. ROCE shows how well the business is generating returns on all the capital it uses, whether debt or equity. It's a key measure of overall capital productivity.
What other types of ratios are important?
Lots. Profitability ratios, like net profit margin, PT divided by revenue. Activity ratios or efficiency ratios, which measure how efficiently the company manages its assets, things like accounts receivable turnover, how quickly it collects cash from customers, accounts payable turnover, how efficiently it uses credit from suppliers, inventory turnover, how quickly it sells its inventory, and asset turnover, how much revenue it generates for every rupee of assets.
And leverage ratios.
Yes, besides DE, the interest coverage ratio is important. That's usually EBIT divided by interest expense. It measures the company's ability to cover its interest payments from its operating profits. A higher ratio indicates a greater capacity to service debt, which means lower financial risk.
Okay, so after analyzing all this past and present financial data, analysts then try to look forward.
Yes, financial projections are a key part of the output. Based on the analysis of past performance, understanding the industry trends, management's plans and guidance, and making assumptions about future economic conditions, analysts build financial models to forecast future revenues, profits, and cash flows.
But forecasting is hard.
Incredibly hard. As the source notes, quoting figures like Buffett, making accurate predictions about the future is notoriously difficult. The future rarely unfolds exactly as expected. Models are built on assumptions, and those assumptions can be wrong. Analysts need to be humble about the precision of their forecasts and consider how the future might differ significantly from the past.
What about dividends? Is that part of the financial picture?
Yes. Studying a company's dividend history and policy is important. Dividends represent a direct cash return to shareholders, so they're part of the total return equation. The dividend policy, what proportion of profits the company decides to distribute as dividends versus retaining for reinvestment in the business, can also send signals. A stable or growing dividend might signal management's confidence in future earnings, while cutting a dividend might signal trouble.
Okay, beyond the regular financial performance, companies sometimes undertake specific actions that impact shareholders' corporate actions.
Right. These are important events analysts need to understand and factor in. A key concept here is the record date or book closure date. That's the cutoff date used to determine which shareholders are eligible to participate in or receive the benefit of a corporate action.
What are some of the most common corporate actions?
We already mentioned dividends, the company distributing part of its profits back to shareholders. In India, SEBI mandates these are declared in rupees per share. Then you have rights issues. This is when a company offers new shares only to its existing shareholders, usually at a discounted price, in proportion to their current holding. The goal is typically to raise fresh capital for the company. If all shareholders subscribe, their proportionate ownership remains the same, but the total number of shares increases.
What about bonus issues? Are they the same?
No, a bonus issue, sometimes called an equity dividend or stock dividend, is different. Here, the company gives free additional shares to existing shareholders, again in proportion to their holding. These shares are issued out of the company's accumulated reserves or profits.
So shareholders get free shares. Sounds great.
Well, yes and no. It increases the number of shares outstanding and reduces the company's reserves on the balance sheet. But the company doesn't receive any cash. And critically, the market price per share typically adjusts downwards proportionally after a bonus issue. So the total market value of your holding usually remains the same immediately before and after the bonus. It's like getting more slices, but the pie itself hasn't grown.
Ah, okay. What about stock splits?
Stock splits achieve a similar outcome for the shareholder, but through a different mechanism. A split reduces the face value or par value of each share in a certain ratio, say 2-for-1 or 10-for-1, and proportionally increases the number of shares outstanding. Again, the market price adjusts downwards.
Why do companies do splits or bonuses if the total value doesn't change?
Often, it's to make the share price appear more affordable or accessible to smaller retail investors, potentially increasing liquidity or trading volume. It's largely a cosmetic or book entry change with little direct economic benefit, though sometimes it can have a positive psychological effect on the market's perception of the stock. Share consolidation, or a reverse split, is the opposite, increasing the face value, reducing the number of shares, and increasing the price per share.
What about bigger, more structural changes?
You have mergers and acquisitions. M&A. A merger is typically when two companies combine into one. An acquisition is when one company buys another company, or its assets or shares. The goals are often things like achieving synergies, cost savings or revenue enhancements, gaining market share, diversifying, or acquiring technology or talent.
And the opposite of merging.
That would be a demerger or spin-off. This is when a company separates one of its business units or divisions into a completely new independent entity. Shares of this new entity are then typically distributed to the existing shareholders of the original company. This allows the separated businesses to pursue their own distinct strategies and potentially unlock value.
Any other significant actions?
Yes, things like loan restructuring, where a company modifies the terms of its existing debt, perhaps due to financial stress. Share buybacks are common too, where a company uses its cash to repurchase its own shares from the open market. This reduces the number of outstanding shares, which can potentially increase earnings per share, EPS, and return cash to shareholders who sell.
What about shares disappearing from the market?
That's delisting, removing a company's shares from trading on a stock exchange. If it's a voluntary delisting initiated by the promoters, there are specific regulations requiring them to offer an exit opportunity to public shareholders, often through a reverse book-building process to determine the price. There are conditions around the promoter holding needing to reach 90% and sufficient public shareholder participation.
And share swaps.
That often happens in acquisitions. Instead of paying cash, the acquiring company gives its own shares to the shareholders of the target company being acquired.
So many things can happen. After doing all this analysis, economy, industry, company financials, corporate actions, the analyst needs to pull it together into a valuation.
Exactly. This is where you try to estimate the security's intrinsic value, what you believe it's truly worth, based on its fundamentals and future potential, and then compare that estimate to the current market price being quoted on the exchange.
And the comparison tells you.
If your estimated intrinsic value is significantly higher than the market price, MP, the stock might be considered undervalued. If IV is significantly lower than MP, it might be overvalued. If they're close, perhaps it's fairly valued.
What methods do analysts actually use to arrive at that intrinsic value estimate?
The source outlines a few approaches. One is cost-based valuation, looking at what it would cost to recreate the assets, but that has limited use for market investors analyzing ongoing businesses.
Okay, what's more common?
Market-based or relative valuation is very common. Here, you compare the company you're analyzing to similar publicly traded companies, its peers, or to historical trading levels using valuation multiples.
Multiples like.
The most common are based on price, like the price to earnings, PE ratio, price to book value, PBV ratio, or sometimes price to sales, PS. Others are based on enterprise value, EV, which considers both debt and equity, like EV/EBITDA, EV/EBIT, or EV capital employed.
Are there industry-specific multiples?
Yes, definitely. For mutual funds, you might look at price to net asset value, NAV. For infrastructure companies, maybe EV capacity. For non-banking financial companies, NDFCs, perhaps price-adjusted book value. For insurance companies, embedded value is a key metric.
But you have to be careful just comparing multiples.
Absolutely. You can't just say company A's PE is 20 and company B's is 15, so company B is cheaper. You have to dig deeper. Does company A have much higher growth prospects? Is it less risky? Does it have higher quality earnings or a stronger balance sheet? Multiples are a useful starting point, a shortcut, but they need to be used cautiously, always considering the underlying differences between companies.
What about trying to value a company on its own merits, not just relative to others?
That's the income-based or absolute valuation approach. The most common method here is the discounted cash flow, DCF model.
DCF? How does that work in principle?
The core idea is that the value of any asset is the present value of the future cash flows it's expected to generate. So with DCF, you try to forecast the company's future cash flows, usually for a specific high-growth period, say 5 or 10 years. Then you estimate a terminal value, which represents the value of all cash flows beyond that forecast period, often assuming a stable, perpetual growth rate or using an exit multiple.
Okay, forecast cash flows, get a terminal value, then what?
Then you discount all those expected future cash flows, including the terminal value, back to their present value using an appropriate discount rate, which reflects the riskiness of those cash flows. The sum of those present values is your estimate of the intrinsic value.
What kind of cash flows are used?
There are two main types used in DCF. Free cash flow to equity, FCFE, represents the cash flow available to equity holders after all expenses, debt payments, and reinvestment needs are met. This is discounted using the cost of equity. Free cash flow to firm, FCFF, represents the cash flow available to all capital providers, both debt and equity holders, before debt payments. This is discounted using the weighted average cost of capital, WACC, which blends the cost of equity and the after-tax cost of debt.
That sounds complex and full of assumptions.
It absolutely is. The biggest challenges, as we touched on with forecasting, are accurately projecting those future cash flows, which is inherently uncertain, and then choosing the right discount rate and long-term growth assumptions for the terminal value. Small changes in these assumptions can lead to significant changes in the final valuation.
So DCF gives a precise number, but it's built on estimates.
Exactly. Valuation, especially using DCF, is highly sensitive to the inputs. It provides a framework for thinking rigorously about value drivers, but the output is only as good as the assumptions you feed in. It's subjective.
How do analysts handle valuing really complex companies or maybe new types of businesses?
For diversified companies with multiple distinct business lines, they might use a sum of parts, SOTP valuation. You value each business segment separately using an appropriate method, maybe DCF for one, multiples for another, and then add them up, adjusting for corporate overheads or synergies.
And new age businesses, like tech or e-commerce that might not have profits yet.
That's definitely a challenge for traditional valuation metrics. The source acknowledges this difficulty. Analysts might look at non-traditional parameters like the number of users, eyeballs, subscriber growth, average revenue per user, ARPU, gross merchandise value, GMV, trying to gauge potential future scale and profitability. But ultimately, the source echoes a more traditional view, often associated with investors like Buffett. Eventually, that value has to translate into actual sustainable profits and cash flows for the owners.
So valuation is definitely part science, part art, and heavily dependent on judgment and those future assumptions. Okay, let's pair valuation now with the other essential concept. Risk and return. They go hand in hand.
Yeah, absolutely inseparable in investing. Return is simply the gain you make on an investment. It can come in two main forms: periodic income payouts, like interest from bonds or dividends from stocks, and price appreciation or capital gains when you sell the asset for more than you paid.
How is return measured?
You can calculate a simple or absolute return, just the percentage gain over the period. To compare investments held for different lengths of time, you often use annualized return. And for investments held over multiple periods where compounding matters, the compounded annual growth rate, CAGR, gives a truer picture of the average annual growth.
Okay, that's the return part. What about risk?
Risk is the other side of the coin. It's the uncertainty surrounding the return, the potential for loss, or the possibility that you won't achieve the return you expected.
Are there different types of risk?
Oh yes, many types. The source mentions business risk, also called operating risk. This relates to the company's own operations. Things like competition, changes in raw material costs, labor issues. Then there's financial risk, which arises specifically from the company's use of debt, financing the risk of not being able to meet its debt obligations.
What about broader market risks?
Yes, market risk is the risk of losses due to factors that affect the overall market, like changes in interest rates, interest rate risk, fluctuations in currency exchange rates, currency risk, political instability, political risk, the risk of a country defaulting, sovereign risk, or the risk of not being able to sell an asset quickly without a significant price drop, liquidity risk.
Are there risks specific to certain types of investments?
Sure. For bonds, there's a call risk, the risk that the issuer buys back the bond before maturity, usually when interest rates have fallen. And reinvestment risk, the risk that when a bond matures or pays interest, you have to reinvest that cash at lower prevailing rates. Country risk captures the specific risks associated with investing in a particular country.
The source makes a crucial distinction between systematic and unsystematic risk. What's that about?
This is really fundamental to understanding portfolio diversification. Systematic risk is risk that affects the entire market or a large segment of it. It's undiversifiable risk.
Like what?
Think major government policy changes, significant economic downturns, widespread natural disasters, wars, major shifts in interest rates or inflation. These things tend to impact almost all investments to some degree. Systematic risk is often measured by beta.
Beta.
Beta measures how volatile a particular securities price has been historically relative to the overall market, usually represented by a market index. A beta of 1 means the stock tends to move in line with the market. Beta greater than 1 suggests it's more volatile than the market. Beta less than 1 suggests it's less volatile.
Okay, so that's systematic market-wide risk. What's unsystematic risk?
Unsystematic risk is risk that is specific to an individual company or maybe a very small group of companies or a specific industry. Things like a factory fire, a major product recall, the outcome of a lawsuit, a strike at a specific company, unexpectedly poor management decisions, loss of a key contract. These are company-specific or industry-specific events.
And the key differences.
Unsystematic risk can be reduced or even largely eliminated through diversification. By holding a well-diversified portfolio of securities across different companies and industries, the company-specific good news and bad news tend to cancel each other out over time. You're left primarily exposed to the systematic, market-wide risk that affects everything.
So diversification tackles unsystematic risk, but not systematic risk.
Exactly. Systematic risk is the risk you get paid for taking, theoretically. The source does caution, though, that beta is a historical measure based on past volatility and doesn't necessarily predict future risk or returns perfectly.
Since we know valuation models depend heavily on assumptions, how do analysts deal with the risk that their assumptions might be wrong?
One important tool is sensitivity analysis. After building a model, say a DCF, you systematically change your key assumptions like the growth rate, the discount rate, profit margins within a reasonable range, and see how much the resulting valuation changes.
What does that tell you?
It shows you which assumptions have the biggest impact on the valuation and gives you a sense of the potential range of outcomes if your base case assumptions turn out to be off. It highlights the sensitivity, but again, the output is only as good as the quality of the inputs and the range you test.
What about the concept of margin of safety? How does that relate to risk?
Margin safety is a core principle, famously advocated by Benjamin Graham, the father of value investing. It's about mitigating risk. The idea is to buy an asset only when its market price is significantly below your conservatively estimated intrinsic value. That difference, that margin of safety, provides a buffer. It protects you against potential errors in your own analysis, because valuation's imprecise, and against unforeseen negative events or just plain bad luck. It's about demanding a discount to intrinsic value to compensate for the uncertainties.
Comparing the broad asset classes, equity versus debt, how do they stack up on risk and return?
Generally speaking, equity stocks is considered riskier than debt bonds. As an equity holder, you're an owner. You have a residual claim. You get paid only after debt holders if the company struggles. But equity also offers the potential for higher long-term returns through capital appreciation and potentially growing dividends. It's growth-oriented.
Then debt.
Debt is generally less risky. As a lender, you typically receive fixed interest payments, coupons, and have a higher priority claim on the company's assets if things go wrong. The potential return is usually lower and capped compared to equity, but is generally more predictable. The right balance depends entirely on an investor's individual risk tolerance, time horizon, and financial goals.
Is there a way to compare investments considering both risk and return?
Yes, analysts look at risk-adjusted returns. The idea is not just to look at the absolute return, but the return generated per unit of risk taken. The source briefly mentions concepts like the Sharpe ratio or Trainer ratio, which are common ways to measure this, although it doesn't go into the calculations. It's about getting compensated appropriately for the risk you bear.
And just to circle back, those behavioral biases we discussed earlier, how do they fit into this risk-return picture?
They have a huge impact. Psychological factors dramatically affect how investors perceive and react to risk and potential returns. Fear of loss can cause panic selling at the bottom. Greed or overconfidence can lead to taking excessive risks at the top. Anchoring to past prices can prevent rational decision-making. Herd mentality can amplify bubbles and crashes. Understanding these biases is crucial for analysts trying to understand market behavior and for investors trying to avoid making emotionally driven mistakes.
Okay, moving into our final major section now. We've covered analysis and valuation, risk and return. Let's talk about the rules of the road, the regulatory environment. Why is regulation so critical in securities markets?
Oh, it's absolutely fundamental. You need robust regulation for several key reasons. First, to protect investors, especially smaller retail investors, from fraud and unfair practices. Second, to ensure the markets are fair, efficient, and transparent. And third, to promote the development and stability of the securities market itself, which plays a vital role in allocating capital in the economy. Without trust and confidence, markets simply can't function effectively.
Who are the main players setting these rules in India?
It's a multi-agency landscape. The Ministry of Finance sets the overall policy direction for the financial sector. The Reserve Bank of India, RBI, is the central bank, regulating banks and managing monetary policy. For the securities market specifically, the key regulator is SEBI, the Securities and Exchange Board of India.
And SEBI's role.
SEBI has a broad mandate: protect investors, promote market development, and regulate the market participants. They have authority over issuers, companies raising capital, intermediaries, brokers, exchanges, depositories, mutual funds, etc., and basically anyone associated with the securities markets. They have powers to conduct inquiries, inspections, issue regulations, and impose penalties for violations.
Are there specific SEBI regulations that directly impact the work of research analysts?
Yes, very significantly. Firstly, there are general market integrity regulations that everyone, including analysts, must adhere to. Key among these are the prohibition of insider trading, PIT regulations.
What does that cover?
It prevents anyone defined as an insider, which includes people connected to the company or anyone in possession of unpublished price-sensitive information, UPSI, from trading based on that information before it becomes public. Insiders also have strict disclosure requirements about their trading. UPSI is basically any information that could materially affect the stock price if it were known.
Okay, no insider trading. What else?
There's also the prohibition of fraudulent and unfair trade practices, PFUTP regulations. This is broader and prohibits any activity designed to manipulate the market.
Like?
Things like creating a false or misleading appearance of trading activity, artificially inflating or depressing prices, using manipulative devices or schemes, spreading false information to induce trading, or executing trades designed purely to manipulate prices without any intention of changing ownership.
So, general rules against cheating. Are there rules specifically for research analysts themselves?
Yes, very much so. SEBI introduced specific research analyst regulations in 2014. The main goal was to foster objectivity and transparency in research reports and recommendations, and to manage conflicts of interest.
How do they do that?
Well, first, individuals acting as research analysts generally need to be registered with SEBI or work for a registered entity, and they need to meet certain qualification and certification requirements, passing the NISM Research Analyst Certification Exam, which this source material is based on, is part of that, along with having relevant degrees or experience.
What about conflicts of interest? That seems like a big potential issue.
It's a major focus of the regulations. They mandate a separation between the research analysis function and other business activities within a firm, particularly investment banking, sales, and brokerage operations. There needs to be an arm's-length relationship to prevent research recommendations from being influenced by the prospect of generating other business for the firm.
So the research has to be independent.
That's the aim. The rules require analysts to have a documented, rational basis for their research reports and recommendations. They need to clearly define the meaning of their recommendation terms, like buy, hold, sell. And there are strict rules about the analyst's own trading activities.
Gotcha.
For instance, analysts generally cannot trade securities of companies they cover in a manner contrary to their outstanding recommendation for a certain period, like 30 days before and 5 days after the report. They also face restrictions on publishing research soon after participating in things like non-deal roadshows for companies, and they absolutely cannot promise favorable research coverage in return for investment banking business or compensation.
That sounds pretty comprehensive in trying to ensure objectivity.
It is. And there are also extensive disclosure requirements that analysts must include in their reports, and even when making public appearances, like on TV.
What kind of disclosures?
They have to disclose things like whether they or their relatives own shares in the company they're covering, whether they or the firm have received any compensation from the company recently, any significant client relationships the firm has with the company, whether the analyst served as an officer or director of the company, or if the firm acted as a market maker in the company's stock. It's all about transparency regarding potential conflicts.
Beyond the specific RA regulations, how else is market integrity maintained?
The stock exchanges and SEBI actively monitor market activity using various surveillance measures. The source mentions things like the graded surveillance measure, GSM, and the additional surveillance measure, ASM. These are frameworks applied to stocks that exhibit unusual price or volume behavior, or whose fundamentals seem out of line with their valuation, essentially putting them under closer watch and sometimes imposing trading restrictions to alert investors to potential risks.
The source also mentioned learning from past crises.
Yes. It briefly touches on lessons from case studies like the collapse of Barings Bank back in the 90s, highlighting operational risks, the need for separation between trading, front office, and settlement back office, proper monitoring of trading limits, and international regulatory cooperation. And the 2008 global financial crisis, pointing to issues like moral hazard, failures in credit rating agencies, inadequate risk management, and the importance of always asking what could go wrong. These historical examples underscore why regulation and rigorous risk management are so crucial alongside the analysis itself.
And for analysts specifically, are there ongoing compliance requirements beyond just getting certified?
Yes, they need to maintain proper records of their research reports, the data used, and the rationale behind their recommendations for a specified period. They need to comply with continuous certification or professional development requirements. Firms also have obligations like displaying an investor charter and information about grievance redressal mechanisms like SEBI's Scores platform on their websites.
Okay, so after all this work, the analysis, valuation, risk assessment, navigating the regulations, it all culminates in the research report itself. What makes a report truly effective?
Well, its fundamental purpose is clear communication. It needs to convey the analyst's findings and reasoning effectively to help the user, whether it's a fund manager or an individual investor, make an informed decision.
What are the hallmarks of a good research report?
The source highlights a few qualities: clarity of the central idea or investment thesis, simplicity in delivery, avoiding unnecessary jargon, a clear, logical argument supporting the conclusion, often a narrative structure that guides the reader through the analysis, and importantly, being customized or appropriate for the intended reader or audience. It's not just about dumping data, it's about building a compelling case.
What sections would a typical report include?
It generally covers the key areas we've discussed: an overview of the company's business and industry context, peer analysis comparing it to competitors, details on shareholding patterns, a discussion of the company's strengths and weaknesses or concerns, an overview of the industry outlook, financial highlights and potentially projections, and of course the valuation analysis and the final investment recommendation.
And those recommendations need to be clear.
Absolutely. The recommendation terms used, whether it's buy, hold, sell, or maybe variations like add, reduce, accumulate, must be clearly defined by the firm, usually specifying the expected percentage return range and the time horizon over which that return is expected. Example, buy, expected return 15% over 12 months.
The source also mentions an analyst checklist. What's that about?
Yes, it sounds like a helpful summary or framework to ensure all the key bases are covered during the research process before reaching a final conclusion. It likely prompts the analyst to consider all the qualitative factors: business model, management quality, governance, risks, competitive position, regulatory aspects, the quantitative factors, revenue and profit growth trends, leverage return ratios, cash flow analysis, the valuation assessment, both intrinsic value estimates and relative comparisons, and ensuring financial discipline and compliance. It's a way to structure the thought process and ensure thoroughness.
Wow. That really was a comprehensive deep dive, wasn't it, into the whole world of research analysis.
It definitely takes you through the entire process, doesn't it? From those big picture economic forces right down to the nitty-gritty of a company's balance sheet and all the rules governing how it's done.
You really get a sense now, I think, of the many different lenses analysts have to use to view the market. It's not just about crunching numbers.
Not at all.
It's understanding industry dynamics, assessing management quality, scrutinizing governance, thinking about the regulatory landscape, even factoring in human psychology. It's clear that being a great analyst is about sort of synthesizing all these different pieces.
Exactly. It really is a blend, isn't it?
Yeah.
Quantitative skills are essential, of course, but so is qualitative judgment, critical thinking, staying curious, and maintaining that rigorous independence and ethical approach we talked about.
So let's leave our listeners with a final thought, something to mull over, building on everything we've discussed today from this material. Here it is. Given that market prices are clearly influenced by human behavioral biases and can often diverge, sometimes wildly, from estimated intrinsic value, and recognizing that even the most sophisticated financial analysis ultimately relies on assumptions about a fundamentally unpredictable future, how much should any investor prioritize understanding and perhaps acting on these behavioral forces and market dynamics compared to relying solely on traditional fundamental analysis and quantitative valuation models? It raises a really interesting, maybe challenging question about the true balance between the art and the science of investing in the messy reality of the markets.